Welcome to new episode of Indian Securities Market Virtual Museum, a special initiative by SEBI where we engage as well as educate the investors. Today I have a personality who has been associated with SEBI since 1997. Yes, you heard it right. He has a close association with SEBI close to 30 years and he has worked in different capacities. So we have a lot to talk about it. Welcome to the show, Mr. J.R. Verma. And my first question to you will be regarding the securities market, where we started, where we are now, how far you have seen we have covered the journey.
Yeah, I think I've had the privilege of watching the complete transformation of the market from a small, you could say a kind of club kind of thing, which was the stock exchange in Mumbai, something that was confined to the trading ring of the stock exchange in Mumbai, to a completely national market with a whole range of instruments having come in, a modern market which is today on par with the best markets in the world. That's a dramatic transformation that has happened over this period.
Of course, you mentioned about it, and there has been structural changes from where we started and where we are now. Can we talk about it now?
Yeah, I think the changes have been at multiple levels.
Right.
One of the changes is obviously technology, which took it from a physical face-to-face market, which by its very nature is confined to one city or even one building, to an electronic market which is national and potentially global. That's one part of that. The second part of it is the modernization in terms of instruments,
Right.
from being only cash equities to a whole bunch of futures, options, index options, and so on. That is another facet of it. The third facet of it is in terms of the participation in the market, from being predominantly retail and the proprietary trading by the stockbrokers, to what is today predominantly an institutional market with a large number of both domestic and foreign institutions. So that's the institutional structure which is changed. Mm-hmm. Also the diversity of the market itself. In today, the Indian equities market has such a wide range of industries. Virtually any industry that you can think about, there is a listed company there. Earlier, most industries were either not listed, or they were government owned, or they were private, or probably they didn't even exist in India. So that is a very, very dramatic thing, So if you just look at airlines, for example, there wasn't a listed airline.
Right.
And you can say the same thing about dozens of such industries, yeah, which have all emerged, some through privatization, some through new companies coming in. But it's been a very, very dramatic transformation at all levels.
Definitely, there has been transformation as well. But when we talk about Indian securities market, we often compare about our peers, how globally things are and where do we stand. What is your view on that?
I think on many dimensions we are today on par with the best in the world. Okay. So definitely, if you look at the secondary market, for example, we have the completely electronic trading. We have online surveillance. We have risk management systems which are among the best in the world. The settlement periods are again world class, and the institutions that are there, the depository, everything that you look at in the secondary market today, I think is on par with the best in the world.
And somewhere, even in some senses, even better than peers.
Yes, in many. I think it is true that, for example, I don't think there are many emerging markets which have the kind of breadth of industries, the size of the market, the liquidity that is there. So, in how many emerging markets can you buy or sell $1 billion? It'll come down to just a handful, and India will be among the top in that. So that has happened. Even the primary market has also been transformed.
Right.
The size of primary market issues. $1 billion equity issue is, quite routine these days.
Yes, of course.
And again, not many markets would have that,
Able to digest
that kind of size of offering. So I think the regulation has also kept pace with that. The disclosure requirements today, So when you look, when I began my career, we used to say that, you have two qualities of disclosure. There is what we used to have in the manufacturing sector also. There is an export quality and there is a domestic quality. Right? So we used to have the same thing here. There is an export quality kind of annual report and prospectus and so on. If they were listed in the foreign market. If they were not, then you had a very, very diluted kind of thing. For our own markets. Today, I think the reporting that you have in the domestic market is as good. And to the extent that when you want to make a global issue, there isn't much that changes. There isn't very much of new disclosures that is required, because everything that was required by the US or European regulators, it's already there under Indian law. So that's a complete transformation.
Yes, even the current chairperson, since she has taken over, has been emphasizing more and more on disclosure. I guess if you take out all her public appearances, the most used word will be disclosure, and which has come in forms of various discussion papers and orders. So what you're saying is, of course, we are moving towards a disclosure-based regime. But do you still think that many of the companies are getting away when you talked about primary markets and there is more to be done?
Yeah, I think we must distinguish between regulation and supervision.
Right.
And to my mind, supervision is a kind of never-ending journey. The regulation, one can get to some degree of stability, that we have regulations for all the important aspects, we are done. And from here onward, there would be only incremental changes. But supervision, enforcement, these are things which are ongoing. And you would have seen that there are problems even in the best of markets in the world. You see frauds happen everywhere.
Certain.
So that is to my mind, that is a never ending journey, because as the regulator, supervisor improves its enforcement capability, the crook is always trying to be one step ahead. So it's a continuous arms race. And I don't think in enforcement or supervision, you will ever get to the point where you can relax and say, yeah, we have reached somewhere. It is like Alice in Wonderland, you have to keep running just to remain where you are, So, but when I say that we are, we can look back with a great deal of pride, I think it is on the regulatory front. Right. The regulations are all there. And I don't see anything which is really missing in terms of regulations. Now, you will always have crooks trying to, stay under the radar and, do pumping of markets, manipulation. Well, it happens in the best of markets in the world. I mean, you have something like GameStop happening in the US. There is nothing much that you can do about it, because you may think that it is all wrong, but, there is no law which is violated. What do you do? Right. And you will have that kind of thing here also. And that, I think, is a never-ending battle. But on regulation, I think we can definitely say that we have, covered most of the ground, and From here, it will be more incremental.
Right. The base you were talking, I mean, since your journey has been from 1997, you have been part of several committees and you have laid down those laws, principles, then those committees, then final regulations. So you know it all, but I would want to start with revised carry forward system. You have headed that committee. How did it went and finally what was the output?
Yeah, I think about that committee as one part of a long transformation from the carry forward or Badla system that existed to the derivatives market that exists today. And there were multiple viewpoints at that time. There were people saying that we don't need Badla, we don't need derivatives. There were people who
There
were
are still people who say that.
Very true. There were people who said we need both. There were people who said we need Badla, we don't need derivatives. There were people who said we need derivatives, don't need Badla. So all possible combinations were there. And if you add in what is the sequencing that should be done, there were even more. The revised carry forward system, I think the key idea there was that the biggest problem in the Badla system was not the product itself, but the risk management of that product. That the carry forward system was a levered product. And if you put leverage into the equity market, then your regulation about that, your managing the risks of that have to be very good. If you don't have good risk management, then you cannot have a levered product. So that was the view that this committee took, that whether you have Badla or derivatives is not as important as asking, do you have the right risk management systems? And what we found was that the thing which was totally lacking was the risk containment system. So I think there was, I don't know whether that number is ever public or something, but I think we asked this question at the height of the Harshad Mehta scam. What was the total amount of margins that the Bombay Stock Exchange had collected? Total. From all players, what was the total amount of margins that was lying with BSE at the height of the Harshad Mehta scam? And if I recall right, the number we got was something like 40 crore.
40 crore?
Yes. Now, and it is obvious to everybody that that was a pittance, right? Yeah. Now, if all that you have is 40 crores from all parts, I'm not saying 40 crores from Harshad Mehta. Right. I'm saying 100 crores from everybody in the market put together. Now, how is that possible? Yeah, now if you look at that, then you realize that this product was simply not being adequately margined. Now, so that committee's report was that, whether you transition from Badla to derivatives, we should do that. At least that was my view from the very beginning, that ultimately it's going to become derivatives. But the most important thing is that you need to put margins here and make this product less dangerous than what it is. And that was the idea, that if you put in adequate margins, then the product is not as toxic as it looks. Right. So that was, I think, the key idea there, that what Badla was lacking is risk containment even more. The flaw is in risk containment and not in the product design. Product design also is deficient, that you have only 2 weeks and you need longer maturities, you need options, you need lots of things. Yes. But I think the driving force of that committee was the most urgent, most important problem is no margins. Let's fix that first.
So margins,
yes.
The issue is not with Dabba trading when you started or Badla trading or now derivatives trading. Process and purpose is more important than yes. the things itself.
Yes.
You have also been part of risk assessing risk in derivatives market, and there was a committee of risk management for derivatives market. So talk us about it in the context which you have given. Of course, this is a step 2 which you have to enhance and work on it. How did you do that?
I think there was a very it was a very interesting situation at that point of time. So I often say that it is important to be in the right place at the right time. Okay, whether you're the right guy is less important. If you're in the right place at the right time, there is a lot that you can do. And the way I see it is that I was in the right place at the right time. When this new product was being launched, I was there at that point, and that was an opportunity.
Right.
So sometimes I think anybody else might have done the same thing.
You are being modest here.
But and I think the big thing that those of us who were involved in that, I think the most important thing that we did was that we took this as an opportunity. There is a cash market. Reforming that is going to be very difficult because there is a whole lot of baggage there, and there is a whole lot of resistance to changing any of the baggage there. But here we are setting up a totally new market from scratch.
Right.
And if you're setting it up from scratch, we don't have to worry about all the old baggage. So the idea was that, okay, something is happening in cash market. Don't talk about that. We would like to change that. We will change it someday. But here we are designing a market on a clean slate. What would we like to have? What risk containment would we like to have? What systems would we like to have? How would we like this market to be designed, to be regulated? And I think many of us there also had this idea that if we do a good job of this and make this market work, then very soon the cash market will adopt all of this.
Okay.
Because there is a demonstration effect. Yes. If there is a modern market which is seen to work well, and the same brokers are working there, and they're able to work in that market, how will they come and say that, yeah, we are able to do all this, we are able to pay margins by, before the market opens, the banking system doesn't work in cash market, but the banking system works in derivatives market. You can't really say that, right? So if you're able to make it work here, then you will be able to reform the cash market as well. So this idea that let us not carry any of that baggage, let us take the full opportunity that this is a new market segment being designed from scratch, and let us think about what is our aspiration. Let us not be bound by what the current market is and say incrementally change this. Let's put the bar, okay, we are creating a world-class market. How will we design this? What risk containment will you have? What are the rules that you will have? And I think that was the way we approached this. And there was also one other thing. I think that will not be in the written record. But there was one thing that I kept saying at that point of time. Whenever anybody wanted, a little looser, laxer thing. And that's why I said it is not on the record. I kept saying that, look, if we make a mistake here, and if something goes wrong in the derivatives market, okay, then India will not have a derivatives market for the next 25 years.
That was a big responsibility you were putting on the soldiers of those who are working with it.
Yes. So we have to be very, very sure that nothing will go wrong, at least for the first 5 years. After the first 5 years, if the system is seen to work, then there is a greater tolerance. You can say, yes, it has worked for 5 years. Okay, something happened, that is an exception or something. And we've been fortunate that, it has run for more than 20 years without a major market disaster. Problem. Yes. No, market-wide, failure or anything has not happened. But this was a conservatism that was there. And I think put that way, even those who were most hurt by the risk management, they also saw the benefit of this, because they also have a long-term view, right? That if you're a stockbroker, you want to make money this month, but you also want to make money for the next 10 years.
Then you have to get into it.
And I think there was a great deal of acceptance of this point, at least by the people who were in that room. And of course, then they would have had to convince the people who are not in the room. But this was one major thing, that we should not goof up here. We should start very conservative, ensure this is, foolproof. So the criticism that has been there, I think it continues even today, is that the Indian derivatives market is over margin. And I think it's a fairly reasonable criticism to make, that we are over margin compared to many other countries in the world. But the point is that over margining has not prevented a very large trading volume. We are also one of the most liquid markets in the world.
Yes, definitely.
Right? So how did that happen? That happened because there was no failure in the markets. Therefore, the market was allowed to expand.
Yes.
And that is how you got to this. So I think I must also say that many of the market participants, and I think that is part of SEBI's job also, to put the right market participants into those committees. You want, as the finance jargon goes, you want people who are long-term greedy.
Yes.
If you put people who are short-term greedy, then you will not get a good market. So I think that
vision was there.
That vision was there. Even the market participants saw this, that they were involved in the creation of a totally new market, which could be much bigger than the cash market. They also felt the responsibility that we should not goof up. And the whole nation is watching what we are doing.
Of course. I mean, rarely it happens that your words of wisdom has worked. You said that if we fail, we will not succeed in next 25 years. But the reverse has happened. We have been successful in last 25 years. But you feel that, conversely, had we not started that time, focus more on, cash segment only, I mean, gone with whatever the wide consultations were there at that time, do you think that we would have not reached here what we have scaled till now?
Yeah, I think the derivatives market has been extremely important. It's been extremely important in providing the liquidity, which is what gives confidence to people to invest in the market. Mm-hmm. There is this confidence that I can do, to use the same number again, I can do $1 billion Nifty index futures trade and hedge all my risk. If I can buy the stocks of a company today, and if I get worried about it in the afternoon, I can hedge it all in the index futures market, and I can hedge the entire market risk away. And now, having that confidence is important. Okay, so let's take a very different example. Mm-hmm. You go and put money in your savings bank account,
right?
And maybe the money just sits there. I mean, the banks mint money because our money sits there. We don't touch it. We don't move it into an FD. It just sits there. But if you ask the question, why does the money sit there? It is because the bank says, anytime you want to withdraw the whole thing, you can take it.
Liquidity.
Yes. Without that liquidity, it doesn't stay there. The promise of liquidity makes that a permanent balance. All the banks make money only on CASA deposits, right?
Right.
You would have known that. But why does the deposit there? Because you can take it out anytime you want. Now, you may not use that liquidity. You may never have used that liquidity. Only thing that you do is to draw 20,000 rupees in your ATM. And 10 times that money is sitting in the bank idle. But that promise and that assurance that you can withdraw the entire 2 lakhs in an instant if you wished is the only thing that keeps that money there. So it is the same thing here. If you said that we want long-term investors in the stock market, this is what people say, we want long-term investors. The most long-term investor also stays in the market only because of the confidence that when that person needs the money, it is accessible. So unless you create that liquidity, even the long-term guy will not come.
Right.
Do you think a pension fund, a US pension fund would come and invest in this market if it is not liquid? That pension fund might have a 20-year horizon, and for 20 years it may not touch that investment that it made. But that investment would not come in the first place if you did not have that 20-minute liquidity.
Right.
And the derivatives market is what has created that enormous amount of liquidity.
Okay, give us a few examples when you talk about risk management system, where we started and where we are now. How far we have covered the distance there, which were the problems to begin with, which you sorted in the committees and also came with regulations. And of course, there will be still problems, which you said that is an ongoing thing, and you need to continuously assess that. But what is the distance which has been covered so far? If you can specify with examples.
Yeah, now the major thing that was covered is that almost everything that we did in derivatives was transferred to cash.
Okay.
So the cash market ran with practically no margins. Institutions were not margined in the cash market at all. And the belief was that, yeah, it is a big institution, it will not fail. Now, derivatives market, we were starting from scratch. We said, we don't care. You may be God himself come to trade, but you have to deposit margins before you can trade. And the margin has to be there before the trade.
Right.
You can't come and say that, yeah, I have traded today, in the evening I will come with the margin. You come with the margin and then trade.
Right.
Now, we were able to do that in derivatives because we were starting the market from scratch. But we were able to gradually turn that into the cash market as well. And what we have seen now is very big institutions can fail.
Right.
We had, and the most vocal were the foreign institutions, saying that providing margins is extremely difficult for us. It involves FX trades, this, that, and so on. But they started doing it in derivatives. And then when we said we will impose it in cash, now it's very hard for them to say that we can't do it in cash because the same guy is giving margins in derivatives.
It's a kind of a bait which others didn't know.
Yeah. So now think about this. There was MF Global which failed.
Right.
The big institution. Credit Suisse, it was bailed out, but there were points of time where we feared that it would fail. Now there was really no need to worry at that point of time, because the thing would be, okay, if Credit Suisse has done a trade in India, it would have paid margins.
Definitely.
Right? So when it comes to the margining, we don't distinguish between Credit Suisse and the man in the street. To both we are saying that show me the color of your money before you trade. Now the big thing that it does is that a big institution fails, we don't care. 2008, so many institutions failed or were saved only by a bailout.
Yes.
We never worried that they will default and the stock exchange will not be able to do a settlement. Why? Because they had all been margined. So that was one very big
achievement.
Very big achievement. Doing that in the translating all of that into the cash market as well, and then the compressing those timelines. The biggest problem when we began, these days you have UPI, instant money transfer, and so on. The biggest problem that we had then was that we could make security settlement instantaneous, but the cash settlement payment systems were not running. When did NEFT start running 24/7? Yeah, it was pretty recent, right? And when did NEFT start? When we did all those, even that was not there,
As we have discussed so far in the conversation that you have headed multiple committees, and if we go on with each and every committees, I mean, our conversation will go on for hours. I don't know if our viewers will be able to have that patience, but I have to get your views on the Secondary Markets Advisory Committee. That was a very important function. So you have dealt with important issues that time. Can you please talk about it?
Yeah, the Secondary Markets Committee was one where a whole lot of these changes happened gradually. Um, it is not one thing which one can say made a big difference. It was gradual changes. One step at a time. A whole lot of things happened. Whole lot of this transferring things from the derivatives to the cash market happens in that era.
Right.
Towards the end, I think we had this interoperability of clearing corporations. That happened during that whole period in which this was going on. So there were a whole lot of things that happened. Also, the role was a little blurred between the Secondary Markets Advisory Committee and the Risk Management Committee. These usually used to meet on the same day. Okay. So forenoon you would have the Secondary Markets Committee meeting, and afternoon you would have the Risk Management Committee meeting.
Some topics were common also?
Some topics were common, half the membership was common, and I would always get confused. This item is on that agenda or this agenda. And I would ask somebody what is, no, they'll say that is coming up in the afternoon in the risk management thing. Okay. But the mandate of the Secondary Markets Committee was much broader than risk management. And it involved a whole lot of issues. It involved a whole lot of customer-facing issues and things like that. So, for example, you would recall there was this issue about failure of some very large broking firms, and allegation that they had misappropriated customer money. So this was a very major concern, I think, in the late 2010s and early 20s, how to deal with that problem. So the difficulty with that is that you are now talking not about the regulator broker interface directly or the exchange broker interface. You're talking about the broker client interface. What is happening there is, it is much harder to regulate or supervise. And there were a whole lot of regulations which tried to ensure that the customer does not have to trust the broker with the cash.
Okay.
This is a guiding principle, that the broker is there to execute a trade. The broker should not ideally even need to touch your cash. Right. Ideally, your cash should go straight to the clearing corporation to settle the trade. It is, and similarly, your securities should not, ideally, the broker should not touch that. So this is very difficult to operationalize, and I think we must have had several meetings trying to make this work. And the problem is, there are times where the broker needs to have access to that. If the broker is lending money to the customer on a margin trade and so on, then the broker needs to have access to the cash. But we should also have provisions where the broker does not have access to the cash. Extremely difficult issues about operational logistics. But I think, finally it has happened. And concern was also that one should not throw the baby out with the bathwater, make the system so difficult.
Yeah,
that you
brokers, if they want, they cannot do anything
about it. So it was a very, very difficult, challenging thing. I think we took several meetings over several months to thrash it out. But I think that has worked. I think technology has made a lot of problems went away because of technology as well. But today it is possible. It is possible for you to have a trading account in which your broker does not have a power of attorney on your demat account. and it was very difficult to get to that point. They would say, no, without that it won't work. So there were lots of those kinds of things. Interoperability, and these are the more recent ones that happened. But there were a whole lot of those kinds of things, Again, that is, I don't know whether it was in here or in risk management. The first time we raised this question about what is the exposure of the stock exchange to a bank? Mm-hmm. How many thousands of crores of bank guarantees have you taken from a single bank? And how confident are you about the solvency of that bank? The first time this question was raised, it was like, did I hear you right? Are you saying we should worry about whether a bank is solvent or not? And those days it used to be predominantly public sector banks and a handful of these. But, after 2008, we know the largest banks can fail. Yes. So forcing the clearing corps to say that, look, we will have an exposure limit on a bank. Maximum exposure that we will have to a bank is so much. And if you cross that, we won't take a bank guarantee from that bank. Right. Question whether a bank can give its own bank guarantee as margins for its trades. These kinds of ridiculous things came up. You would think, how can you give your own guarantee for margins for your trades? But the bank saying, yeah, that is the easiest thing to do. We will do that. So it was a lot of fun debating that and getting that done. It was so many years, Probably it took 10 years to get a lot of this done. Right. Yeah, but it was fun.
That most difficult part of the regulator remains to foresee something which is not happening right now, but to predict kind of a future which may happen later. And that time, of course, you will get all kind of different dissent voices. But that is what hard part of the regulator is, and you have been managing it. One of the most important committees which I feel we have talked about equity, talking about bonds. You were associated with a committee called Uniform Valuation Methodology for Pricing of Corporate Bonds by Ministry of Finance. There were also challenges because the corporate bonds market is something per se which has been, that kind of pace has not been there. So under your regime, when you were part of this committee, what were the issues you discussed and dealt with it?
The major problem is that we have not been able to make the corporate bond market anywhere near as liquid as the equity market. Right. And that is what is the underlying problem. And this committee was precisely about that. So there was an example, I won't name the company, its bonds. There was one valuation agency which was saying that this bond is almost a distressed bond, near default, and it should be marked down to probably something like 60 paise in the rupee or something. Okay. That is one view. At the same time, this bond is trading in the market at close to par. There is a market price. There is a trade happening in the market where the bond is changing hands at close to 100. So much difference. Yes. And there is one which says that it is on the verge of default and therefore it is worth only 60 paise. There is a trade happening. There is another valuation agency which is saying that, look, there is a trade happening at 100, we have to respect the trade. You look at the rating agency says that I have not downgraded it. Now this is the difference of opinion that exists on one bond. Now imagine what that would do to two mutual funds. Let's say two mutual funds are owning the same bond. One mutual fund goes by the view there is a market price, this bond continues at 100. And another mutual fund says, no, I will go by this valuation agency which says that it is 60 paise.
And that should not be there.
That should not be there. That is one. Suppose this 60 paise valuation is correct. What happens to the smart guy who owns bonds in the first mutual fund where it is still marked at 100? That guy will say, I know that this company is going to default, but this mutual fund is still valuing it at 100. The smart thing for me to do is to withdraw all my money from this mutual fund. Yes. And he will get all the money valuing the bond at 100. Yes. And then if the bond actually defaults, the loss will fall on all the retail investors who are stuck there.
Definitely.
Now, Now, what is the problem really? The problem really is that the trades that are happening in that market are so small and so infrequent that you can't really trust that trade.
Right.
See, you would never ask this question about the equity market.
It cannot happen.
It cannot.
I mean, this kind of arbitrage is not possible, even if it is very minimal.
Yeah. So, and if it definitely it can't happen in a liquid stock where there are hundreds of crores of rupees being traded.
Right.
So, in my academic work, when I want to know what is happening to a bond, I go to the many of these companies have raised dollar debt, and those bonds are traded in the US market. I can go to the US. There is a Traces website in the US. You can go there and see the bond prices, and it trades every day. Now, why does that same bond not trade in the Indian market? So sometimes I joke that India has a very good corporate bond market. The only problem is it is in New York and not in Mumbai.
The people are involved, but not here.
Not here. The same companies are borrowing large amounts, and it is liquid. It is traded. I asked around, can you get a credit default swap on these names? They said, yes, top 20 names you want a credit default swap, I'll get you. There is a quote available. Now, why is that not there in India? So, I have often believed that you actually have to put the cart before the horse, which is what we did in the equity segment. We created a derivatives market, made that liquid, and that liquidity seeped through into the cash market. And I believe that we will have to do that in the bond market as well, that you create a derivatives market in bonds, that make that liquid, which is easier to do because derivatives are, inherently levered products. It will attract all kinds of day traders will also come, and the same day trader who's trading equities will also trade corporate bonds. The liquidity will come, and maybe you could have index derivatives in bonds. They will trade, and the liquidity will seep through into the cash market. There's a traditional view that you can't have a derivative unless the cash market is liquid. But sometimes putting the cart before the horse makes sense.
As I was talking to you before, that seeing the future, when something which is not there currently and something which is a possibility in near future is the job of the regulator, and you've given a valid suggestion for having a derivative for bond market. But one question I would like to ask on behalf of a few young investors who would be watching this, and many of the corporates are giving ESOPs. We all receive it, but I'm sure there is a story to it. There is a journey to it, and this is some regulations which has been in the eyes of regulators, tax authorities. How did you develop this regulation in a manner now that is easily distributed by companies now?
Yeah, that was one of the most interesting committees that I chaired, and it was also an absolutely distinguished committee. Infosys chairman Narayan Murthy was on that committee. Interestingly, there was a trade union leader also on that committee.
Okay.
I think it was, if I remember right, it was the SBI Bank Officers Union, the president or chairman, whatever they call it. He was also there in the committee. I think all these chambers of commerce were there, ASSOCHAM, NASSCOM. So it was an extremely high power committee. And this was long before a lot of the legal framework was there. Even the accounting standard for ESOPs was not there. And some companies had done this by creating a trust, and the trust used to issue ESOPs, which was not a scalable model at all. And it was also made problematic because of other regulations of SEBI. You had the preferential issue regulations, which prevented companies from just giving shares to anybody they liked. And ESOPs were getting caught in that as well. So there was this committee, and I remember the first meeting, the set of questions were there, what kind of restrictions should we impose on ESOPs, because they're very dangerous things, and companies can abuse this. So we had a suggestion, all kinds of suggestions. You should have maximum cap on this, you should have cap on this, there should be a limit on how you price it and so on. And it was amazing how that committee very quickly came round to the view, and I think Narayan Murthy played a big role in that, and lots of the other members also played. And we came around saying, no, we will not have any restrictions. We will not have any restrictions on any of this. By and large, no restrictions, except disclosure and shareholder approval.
Okay.
So the entire report says there are only two principles.
That was quite a bold step at that time.
Yes, and the report openly wrote that it is responsibility of SEBI to encourage ESOPs, because that is how a whole lot of economic activity would happen. Because India, the intellectual property based companies are so important. Knowledge intensive businesses, right. Pharma, IT, everything is knowledge intensive, and knowledge intensive businesses cannot run without ESOPs. So we said that ESOPs must be encouraged, and we said only one thing, only these two things: disclosure. We said that the entire ESOP scheme should be approved by the shareholder, and very large issuances. If you issue more than, I forget the number, if you issue more than so many ESOPs to a single individual, then that individual grant should be approved by the shareholders. If you're giving to rank and file, shareholder does not need to know the names. But if you got approval for 1 million ESOPs and gave all 1 million to one guy, then by name you have to say that I'm granting it to this guy. So that is shareholder approval. And then if the shareholder is approved, why should the regulator object? This is one part of it. Second part of it was the disclosure thing. And at that time there were no accounting standards. That ESOP's expenses didn't have to be put on the balance sheet. And most companies were not disclosing it. So we said that no, ESOP expenses must be shown on this. You must have accounting for that. First objection was SEBI can't impose accounting standards, that is company law, CA Institute and all of that. And the committee's response was no, we are not changing accounting standards. This is permitted by the current standards? I said yes. No, CA Institute has not said that you cannot expense it. They've only said you are not required to. Okay, so we are not violating any existing standard, we are not. And this is the condition for using this scheme. We are not forcing you to use this. But if you don't use this accounting standard, you can't issue the ESOPs under this scheme. You find some other way to issue ESOPs, that is fine. You can't come under this scheme. And this is again the importance of having people on the committee who are forward looking. They're saying that yeah, there will be an expense, but that is fine. I think some pharma people were also there on that committee. And then of course ESOPs have taken off.
Yeah. So all those who are watching and have received ESOPs in their career, they can thank Mr. J.R. Verma, they can thank SEBI for having that forward-looking.
And Narayan Murthy and
of course,
and the SBI union chairman.
I said SEBI, all the people involved. One of the things which we keep hearing about these days is ESG. More talked about, but still I would say less in practice. Of course, there have been efforts by the regulator, not just one regulator, SEBI, RBI. All the regulators are kind of nudging companies to go into those standards, and plus voluntarily also we have seen that few of the companies have actually done that. Do you feel that this should come from company side, kind of a self-regulation, or do you think that regulator needs to do more work on this?
This is again very squarely a disclosure issue. Okay. So I think at this point of time, from a securities market regulator point of view, there would be a different viewpoint from the environment ministry or something. Right. So the environment ministry can say you can't burn coal anymore. That's a different kind of a thing. But it's not the securities regulator who can say that you cannot burn coal or you cannot, or it is it is the transportation ministry which is saying that all cars should be EVs, and that is not part of the securities regulator.
Right.
The job of the securities regulator is to say that, look, these are risks. So if all that you are making is fossil fueled cars, and you know that the world is gradually going to go to EV cars, this is a risk for your basic business model itself. Now you're taking that risk. That may be a risk worth taking. We are not here to question that. Your strategy says that we won't do EVs now. We will do it 3 years later when the technology is improved. That's all fine. But you have a duty to disclose to your shareholders where you stand on this.
Okay.
How much of carbon emissions are you doing? How good is your governance? What is your social responsibility? Because these are all flashpoints. And if you make mistakes on any of this, these can be existential threats to the company.
Right. I was coming there. I mean, this is not something that you need to aware about what is happening globally, how you will be able to sustain, let's say, 10 years, 20 years down the later. And these norms are important not only for doing some kind of charity, but your own existence.
So you need to disclose. And if you disclose, if somebody goes and discloses that, I have only fossil cars and for the next 20 years I don't plan to do anything with EVs,
right,
then it is up to the shareholder to look at that and say whether he wants to buy that stock anymore. And the shareholder might decide that, look, this company has no future. If it's not doing EV today is fine, but if they're not going to do EV for the next 10 years, then this is not a business worth buying, and the shareholder will rebel.
Right.
So disclosure is required. You got to disclose where you are on each of this.
But many of the disclosure these days are just for the sake of doing it. I will look like that I'm following ESG practices, but you actually see in details. I mean, the details may not be there. Of course, there has been laws and enforcement has been there from SEBI as well, that you not only disclose but actually act on it. But rule being rule, as you're saying that voluntary basis also. This should come from companies themselves.
Yeah. So you see these kinds of things, when there are big changes happening, the way it always happens is that the best companies will do it.
Right.
They will do it voluntarily. Maybe even without a regulator, they will do it. But if the regulator imposes some standards, they will all do it in the same way. Otherwise, if you had 5 world-class companies, they will make 5 different disclosures, and each disclosure would look, okay, this company is doing it, nobody else is doing it. Another disclosure, this company is doing it, nobody else is doing it. But what the regulator does is that at least the top best companies in India will have a disclosure in some format. And then what happens is that the shareholder starts expecting this
from the regulator,
from the other companies. It becomes a mark of your quality.
Right. If one is doing that, other is not doing that.
Then it tells you that, look, why are they not disclosing? Because if they make the disclosure, it will all be rotten.
Right.
So you infer that way. You infer that if somebody is not doing a disclosure, it means that their performance on that metric is really bad. And then the shareholder punishes the company on that basis. So I think the thing today has to go through disclosure, and it will go through the leading companies doing it, and they're becoming role models for the others. Anybody aspiring to do it will do it, and gradually it will seep through.
A few of the questions I would want to take. One, it will be incomplete if I don't ask about technology. You mentioned in parts that it has played a great role in the transformation of Indian securities market. But can you give us few examples how this has helped SEBI per se in your decisions or in your enforcements as well, that if technology is used, now this will be useful?
Now, think about the whole lot of problems which just disappeared because of technology. And then the regulator does not have to spend time on that and can devote time to something else. So in those days when I was in, SEBI whole-time member and so on, a very big problem in the market was that of forged share certificates.
Okay.
So the allegation has been made against some of the largest business houses in India also. The promoter wants to raise some money, he just prints some share certificates, completely fake share certificates, and sells them in the market. And after some time, you don't know which is a fake certificate, which is a not a fake certificate. The only point where you will know is when you actually send it to the company to transfer the name. And very few will do that because that's a very expensive process. So a share certificate can change hands 20 times over 9 months, completely fake.
Right.
And then you catch it. On whom should that loss fall? Should it fall on the last guy who bought it, on the previous guy, or the first guy who put it into the market? How will you trace back? There was one company which had, I think, they themselves admitted that some mistake had happened, and 99% of the shares in the market were fake.
Oh.
I think it was like they had 10 billion shares and they said actually we have only 100 million shares. All the other 9.9 billion shares are fake.
How will you catch that?
What will you do? And the chairman says, I don't know what happened. People say that the chairman stole all the money. Now, think of now is that problem fixable? How much resources will be needed to go after fake share certificates? You would have probably had to hire a whole army to do that. And think about what the DMAT did.
Definitely.
This entire problem just disappeared overnight. Yes. And the whole set of people who would have been banging their heads in SEBI struggling with fake certificates can now devote time to something else.
This has happened only because of technology.
No, it has happened because of technology, but it has also happened because the regulator
definitely
played a role. And I must tell you that when the DMAT was first introduced, the question always came, who is the first guy going to DMAT? If all the market is trading physical shares,
right,
and I convert my shares to DMAT, how will I trade them? Everybody wants physical shares. I'm holding DMAT shares.
It's not tradable.
It's not tradable.
Right.
So somebody has to bell this cat.
Right.
So SEBI's first thought was that the big institutions must do it. It is for them that the physical certificate is such a big problem. See, for somebody who has 100 share certificates, you put it in a locker at home, it is fine. For a big institution, when they buy and sell shares, they used to get truckloads of share certificates. That is a very big problem for them. DMAT is a big advantage for them. They should be the first to go to DMAT.
Definitely.
And they were refusing to do it. And finally, the regulator had to say, for all institutions, these shares will be tradable only in DMAT. They came and grumbled, screamed.
Right.
Look, the institution has to bear the responsibility for that. And you do it 25%, 50%, 75%.
Right.
And once half the market is on this, then everybody else voluntarily, the entire retail did it voluntarily. Because then it was that if you wanted to trade, it had to be DMAT.
Yes.
Because the big institutions are trading only DMAT, the liquidity is only there.
Right.
But the biggest institutions, including the foreign institutions, were unwilling to do this until a regulatory stick was applied. So you need a regulator who is pro-technology. Technology by itself will not do the job.
Right.
You need a regulator who is pro-technology and says that this is in the long-term interests of the market and I'm going to inflict short-term pain on you.
Right.
Get it done.
There are still many topics which I would want to discuss about, but one of the pertinent things which is currently about derivatives markets, as you have dealt with it thoroughly through various committees and reports. SEBI's own research says that 95% of the people are losing money due to trading in future and options. And of course, these are the traders who are not well educated or guided. They are just taking their first step and burning their hands, probably. But what is your advice to someone who is new to market? How should he or she go about it?
Uh, it is it is easy to give that advice. It is harder probably to accept that advice and act on that advice. But I speak here as an academic rather than
Right.
as a regulator. Equities are absolutely wonderful things for a long-term investor. If you're starting your career and you went and bought an index fund and held on to it for 20 years till you retire, the chance that that fund will do badly is very, very small. You are almost certain that not only will your principal be intact, you are almost certain to do better than you would putting the money into a fixed deposit and rolling it over for 20 years. This is what the data says for every country in the world, including for India. India also, we have 25 years of data to show this. So if you're beginning your career, there is a very long investment horizon for you. Putting money into equities, into a low cost index fund, and just forgetting about it.
Right.
Not bothering to look at daily price gyrations is almost guaranteed. I should not use the word guaranteed, but it is extremely highly unlikely that that would be among the best investments that you made. Okay, that is the way to look at equities. Very great in the long run. Chances of losing money in the long run very, very low. But the shorter the horizon becomes, the probability of losing money keeps increasing. If you buy a stock and sell it next day, 50% chance that you will make money, 50% chance that you will lose money.
Yes.
If you hold it for 20 years, it is probably 90% chance that you will make money and 10% chance that you will lose money. So you must make time work for you. And you must do that at low cost. The lowest cost investment strategy is what would work. You must start saving as early as you can, because then money compounds for longer. Invest it in stocks, invest it in low cost things. And that is really what you should be doing. Everything else you can do for fun.
Right.
Nothing prevents you from doing day trading in options, so long as you say that this is a game that I'm playing. And you think about this as a game. If you say that I'm doing this for entertainment, if you're blowing money away on watching movies and watching dinners, and you say that, look, the amount of money that I would have blown away on 2 dinners, I'm putting that and blowing it away on buying options and day trading, then that's fine. You enjoyed the game, that is fine. But please don't think that is investment.
Right. So that segregation needs to be there. Your idea needs to be clear. Why you are doing it, at least it should be clear to you before jumping into stock market. And if you are doing it, you should do it for longer horizon, as Mr. Verma is suggesting. My last question to you will be that you have a long association with SEBI. You have held multiple positions, many committees. What is one of the most, if I can ask you, top 2 to 3 things which comes in the back of your mind that these top 3 decisions I have taken, I'll remember forever?
I don't think that any of these were my decisions.
Okay.
Right? First of all, I wasn't SEBI chairman. Okay, so I was only a full-time member, and most of these, all the important decisions, probably even the chairman, cannot really say that this was his or her decision. Right? Most of these decisions require the board, and committees, they're there only to advise.
Right.
They are not decision
But
making.
many of your advices have been taken into consideration and they are act now.
That is fine, but when I accepted these advisory things, I said that look, I want the two things to be very clear. First is that this committee is only giving advice,
Right.
and it is up to SEBI to accept or reject that advice.
Of course.
And I will never come and say that look, we gave you this advice and you did the opposite of that.
Right.
I will never say that, because this is only advice. You're free to accept or reject that advice. But the flip side of that is also that you can't tell me what advice I will give you. You may not like my advice. You're free to reject it.
Right.
But you can't come to me and say, we have decided on this. Can you advise us that this is the right thing to do? Right. So, and I think that has been the way the relationship with SEBI has been. They know that I may shoot down their most favorite theories. And I always tell them there is nothing that forces you to bring the matter to this committee. SEBI does not need to consult a committee at all. It is free to act without consulting the committee. It can consult the committee and reject it. But if you bring it to the committee and I am there, I will talk my mind whether you like it or not.
That is what matters, I guess, and that is what has proved to be results in for at least investors what we are experiencing these days in Indian security markets per se.
And I think that's the great thing about SEBI. I have been in these committees under several different chairs, and the thing has been that they have respected that. They've been willing to accept things where I was saying things which are quite opposite to what they believe. I tell them, yeah, you can ignore everything that I'm saying, but if you ask me, this is what I will say. And they have been willing to listen to that and tolerate me while I say all these unpleasant things.
Mr. Verma, it is a pleasure speaking to you, and I am sure many of the viewers who are watching this episode would say that there should be part 2 of this conversation, because there are many unfinished conversations. I had to stop because of the limited time we had, but thank you so much for giving time, and for our investors there has been clear messages which has been given by Mr. Verma for your trading, for the history which has been so far, and the way he has tackled the advisory committees which he was part of has been something to learn for. Thank you so much once again.